Fed's basically having a hard time figuring out what the effect of this small rate hike will essentially do to the financial markets. The banking system as a whole doesn't need to borrow because it's sitting on an estimated $2.42 trillion in excess reserves.
70% of all gold production in the U.S. comes from a single state, Nevada. Conventional wisdom says that all the good deposits have been found. But one geologist who's discovered more than 30 million ounces of gold says he knows where to find Nevada's missing gold. And right now, he may be on the verge of being proven right. Investors and speculators can learn more at futuremoneytrends.com/gold.
Hello, everyone, and welcome into CrushTheStreet.com. We got a new interview today and a new guest. His name's Jim Comiskey, and you can actually find him on YouTube by searching his name, Jim Comiskey, and we'll have a link to his channel. And he's got quite a history. He's been in the market since 1983. He's been on the floors at the CME, CBOT, and he's even been a commodities broker in the retail space. And right now he's with IFG Futures Group in Chicago as their senior market strategist. And he specializes in a lot of things, so he's an expert across the board. So I'm really looking forward to having this conversation with him. First of all, Jim, thanks so much for taking the time to come on the show with me today.
Kenneth, absolutely. It's my pleasure to be here.
Jim, I got a lot of things on my mind. There's interest rates. Obviously, the Fed raised the interest rate this week, and it's big news, and I want to get your thoughts on that. But we got precious metals, there's crude oil, currency, the indices. There's so many things, and I know you know a lot about all of these things, especially with your history. But let's talk about the Fed raising rates. They raised rates this week 25 basis points, and there's a lot of talk about this at the moment and what this will mean for the economy. Let's get your thoughts on what this is telling us.
Okay, straight up, Kenneth. First of all, once again, I want to reiterate, thanks for having me on your show here.
Absolutely.
And you say I know a lot about a lot of things. I'm a subscriber to Aristotle. A wise man admits he knows nothing. But I've been doing this like 33, 34 years. 16 years of that was institutional, dealing with the biggest banks in the world, and then since 2000, I've been dealing with retail customers, both big and small. And at this stage of my career, it's absolutely a pleasure and an honor to give back to people that share the passion of the markets, in the markets with me. But first, I got to do this. I got to satisfy my legal department. So bear with me, please. Apologize. But we do have a lot to talk about. A lot of really cool stuff that you're not going to hear anywhere else. I'm the guy that's behind the curtain, and I'm willing to open that curtain and show you guys what the guys behind the curtain talk about. All right? But hey, allow me to do this. Satisfy legal. There's a significant risk involved in trading futures and/or options on futures. Futures and/or options on futures trading may not be suitable for all investors. Investors should consider these risks and evaluate their suitability based on their financial conditions. Past performance is not indicative of future results. However, the commodity markets, the indexes, as you mentioned, Ken. All right, so let's get one thing straight. It's Kenneth, not Ken.
Either one. I get called either.
Whatever. Well, yeah, I get called Jimmy, James, Jimmer, whatever. So I'm with you. All right. So let's be kind of informal here because that's my style. But let me quote you up just for your edification because you could be listening to this, an hour from now, 3 days from now, a week from now, a month from now. But anyways, it is currently the 17th of December, about 10 after 4 Central Time. S&P closed down 37.5 points. Big sell-off. 34.5 basically. Dow down 292. The big mover, and we're going to focus a lot on this, the dollar closed closed up 144 to 99.32, and hence mirror image of dollar, and we'll get into this as well. The euro currency closed down 178 to 108.30. Gold down, whoa, big move in the gold, down $27 to 1049.60. Silver down 54 cents to 13.70, and now you are indeed quoted up. Let's talk about why the markets are doing what the markets are doing. And again, no guarantees, but here we go. So the Federal Reserve raised rates 1/4% yesterday. That is like a dust mote on an elephant's rear end in a herd full of elephants. So what does this mean? All right, it means the Fed's basically having a hard time, figuring out what the effect of this small rate hike will essentially do to the financial market. So they went from a target range, Kenneth, of 0 to 0.25 basis points as an interest rate, overnight lending rate, to who? The big five U.S. banks. We'll get into this. Now they've raised rates to 0.25% to 0.5, all right? And prior to today's announcement, the interbank borrowing rate was averaging 0.13. So that since the period quantitative easing began in roughly '08, late '08, early '09, in other words, there hasn't been enough demand from banks for the available liquidity. Now follow me here. I don't want to talk, or Kenneth, if I start talking stupid, you let me know. Okay. But I'm going to try and talk. I'm going to try and talk as like street level as possible.
Okay.
All right. So demand from banks for the available liquidity, all right, the money they borrow, to push the rate up to that 0.25% limit, it was never met, because basically the available liquidity exceeded demand in the old rate range. Banks don't even need to borrow. Do you know why? Because one of the first things that helicopter Ben Bernanke did when he came in 2006 as Fed chair was to institute a policy where the Fed and the Treasury would pay 25 basis points to any bank, a member bank, basically primary dealer. There's currently 19 of them, both foreign and domestic. They would pay them for reserves that they borrowed from the Fed and reparked with the Fed. That's why the Fed's balance sheet has grown exponentially to like $4.2 trillion. But anyways, considering loan loss reserves and all that, look at it this way. The banking system as a whole doesn't need to borrow because it's sitting on an estimated $2.42 trillion in excess reserves. Once again, follow me, please. I'll get a lot more clear and a lot more street level. But the negative impact of the rate hike affects smaller banks that are lending to businesses and consumers. See, the big boys, your J.P. Morgans, your Bank of America, your Citibanks, your Wells Fargo, your Bank of New York Mellon, who are the five biggest banks in the States, are sitting on these reserves. They have no reason to lend these reserves because the Fed's paying them. Basically, they're borrowing at 0 to 0.13, and the Fed's paying them now 0.5% to hold that money. It's a risk-free trade. How often, Kenneth, do you ever hear of anybody in the business talking about risk-free trades? They don't exist.
Never.
But they have since '08. And the big money center banks engineered it that way, along with TurboTax Tim, and I'm not going to get myself worked up into a froth. But I'm going to go back to what I was talking about the little banks, the little regionals. All right, so if the smaller banks, which actually do lend to businesses and consumers because they don't have all these excess reserves, they find themselves fully loaned up in the need of overnight reserves to meet the reserve requirements, they will need to borrow from a bank with excess reserves. J.P. Morgan, Bank of America, Citibank, Wells Fargo, B of New York Mellon. Thus, the rate hike has the effect of making the smaller banks pay higher interest rates, hence higher lending rates to me and you, Kenneth, and anybody listening that possibly senses a pickup in demand and wants to ramp up their production if they own a company, et cetera, et cetera. So the rate hike favors the banks that are sitting on these excess reserves over the banks that are actually lending in communities to businesses and consumers. So this is just another example of the Federal Reserve helping out the 1%. Actually, it's more like the 1,000,000%. Okay, and I'm going to relinquish the floor to you, sir, if you would like to have me elucidate on anything I just said, or shall I continue?
No, that's fine. It's incredible the way it's so manipulated. And at this point, I saw them raise interest rates, and I thought it was really interesting that the stock market on the day of the rate hike actually went up. And it was almost as if the instillment of strength that the Fed chairman and the Federal Reserve came out with to say, hey, we are going to be raising rates. And this defiance of we can raise rates. That's what it is. It's we've been at this rate, 0% interest rate for so long. And basically it was them saying, we can raise rates if we want to. So, and it even that day, it sent the markets up with some set of strength and instilled some sort of confidence. Now, I'm wondering if the fundamentals will overwhelm that confidence in 2016.
My young friend Kenneth, my new young friend Kenneth, brilliant observations. All right, but okay. First of all, let's back up and take your comment point by point. I'm going to forget a couple of those points, but the salient points. Okay. First of all, to survive in these markets, and we're talking, 3 decades of experience talking here, you have to have, and I'm going to get a little, I'm going down a little road here. You have to fear the market above all. Okay? Fear. You got to be afraid of the market. Why? Because the market is the collective, and the market's goal is to basically wipe you out. So fear is a survival instinct, number one. Number two, okay, the market as the collective of all the participants, be it in something that's like really softly traded like coffee or cocoa versus like the euro currency, or the S&P. The collective is always right. Therefore, Mr. Market's always right. The market always demonstrates and human emotions because it's comprised of human beings. Okay, so that's the way you have to view every single market. I don't care if it's live cattle or corn or wheat or crude oil or currencies or whatever. You've got to fear it, you got to work with it, and you've got to deal with it. The market's not wrong, and you're not right unless you're trading with the market and trading with the trend. So you got to try and identify that trend before that trend starts off. Like selling crude at $94, and now she's down at what? Feb crude went out at 36.27, down another 48 cents. We're basically talking 7-year lows in crude, and it's all right. Now I'm going to tap dance a little bit. We're talking copper at 8-year lows. All right, iron ore is at 10-year lows. Steel is at 20-year lows. The precious metals, which I truly regard as gold and silver, are basically at about 5-6-year lows. I'll leave it at that. So the Fed raises rates in the face of what we call deflation. What is deflation? Deflation is commodity markets under pressure. Deflation is currently being exported from China because they continue to value the yuan, which is good for your typical U.S. consumer because all the exported goods out of China are now that much cheaper. But the Fed, in their great Keynesian experiment here, wants to see inflation. They want to see U.S. consumers afraid that the price of, Junior's Christmas toy is going to accelerate. It's going to go up in the next 2 days. So I'm going to spend money.
Mm-hmm.
And that's what they want to see. They want to see an increase in the velocity of money. It's not going to happen. Now, I'm going to go to a couple things that I alluded to earlier. Mr. Market is always right. One of the biggest indicators, and I get this a lot, Kenneth, on my YouTube channel, Jim Comiskey Metals, or Jim Comiskey, is maybe you correctly pointed out, on YouTube. Just go on, tap in and sort by and go to my last week's worth of rants. But, all right, so the Fed hikes rates. The bond market. The yield curve flattened in the last, prior to me going on, the last 17 hours, over 10 basis points to 9-month lows. Comiskey, what is a yield curve and why are you making this so complicated? It's not. All right, Kenneth, I got the knowing laugh there. I'm going to just go Econ 101. A normal yield curve, it doesn't matter what sovereign, U.S., Germany, England, France, whatever, basically is upward sloping. All right, so from overnight money, you got the lowest interest rate paid and received, and up to 30 years, generally the curve in most sovereigns will end at 30 years, should be really high. And that's indicative of the bond markets thinking that we are going to have a nice pickup in economic growth, because investors going out 30 years need to be compensated a little bit more, because we're going to go through this wave of growth, and then potentially we could have a recession in the meantime. So what happened after the Fed raised rates today, 16 hours, last 17 hours? The 230, don't get freaked out. That's a 2-year Treasury note U.S. versus 30-year bond U.S. just collapsed today to 9-month lows. Okay? I'm not going to bore you with the actual level, but it was like 195, 1.95. So the curve, the bond market, the collective, is telling the Federal Reserve that they just really screwed up, because there's no anticipatory growth in the credit markets in the U.S. that the Fed claims that they see. Right? And I think that's a big reason why the S&P dropped 38 points today. And now, Brian, once again, I'm going to let you take the floor, and let's have a free, two-way communication here. Talk to me. Observation, sir. Please.
Well, we've seen the junk yields, the junk bonds collapse as of recently. And I'm curious, because with the Fed raising rates, I'm curious if you think they are going to continue to raise rates as they are alluding to over the next couple years and get to their normalized rates. But if we see this issue with the bonds, is it likely that they will resort to more QE before lowering interest rates? What do you think they'll do first? You think they'll do QE or lower the Fed funds rate if need be?
I really like you, dude. We're going to have to do this on a monthly basis, because you're incredibly perceptive. I didn't want to talk about the high yield stuff, but you're absolutely correct. It all started out with a couple commodity houses, Glencore, which is one of the biggest, it's a European commodity firm, and they got caught long copper, long crude, long corn, and they had to meet massive margin calls, massive liquidation. They had to do what is called gate their fund, where no one can withdraw anymore. No one can redeem their money. And the rest of the street senses when a house is about to go under, and they'll short the hell out of every position that they perceive that fund to be in. And this is somewhat of the environment. But bear in mind now, With the Federal Reserve raising rates and the dollar going up 150 today, basically, it makes commodities in general weaker. Well, there's an expression we use, Kenneth. There's a lot of blood on the board. And most commodities, for whatever it's worth, okay, are sold in U.S. dollars. I don't want to talk about Bretton Woods, 1943, New Hampshire. I'm not going to bore you peeps with that. But so that's one of the reasons why we are having such a weak flow in the commodity space, a major sell-off in the commodity space. A lot of that has to do with the Fed. A lot of that has to do with the People's Bank of China. It is what it is. But World War III, make no mistake about this, is being fought in the foreign exchange markets as we speak. There's not a missile fired. It's all about the race to the base. Now that the Fed has proclaimed themselves being in a position where they can raise rates, the rest of the world is still easing. I do feel that, well, the Bank of Mexico, it's not watched much, raised their overnight lending rate 25 basis points today. The next, Canada can't go there. Our biggest trading partner can't. There's no way they can raise rates with crude oil being as low as it is, because it's their biggest export, and they are our biggest trading partner. The next one that's going to tighten will be Bank of England, and it's already factored in. So you alluded to, is the Fed going to tighten more and more and more? And I ran a little study, and you anticipated where I was going to go here, Ken. And that's why I want to work with you more going forward. So 7 years. In the 7 years since '08, more than a dozen central banks in the advanced world have tried to raise rates and lowered them again. Bank of Japan being the most notable. I could bore you and your listeners and take up another, minute's worth of time with the other central banks, Norway. No, I won't go there. And they had to go back down to zero because their currencies didn't get the bullish boost, and their stock markets got smoked. Again, I won't bore you with those comments. But now, how far into this interview are we, Kenneth? I haven't timed it.
We're at 22 minutes.
All right, you got about 5 more minutes?
Yeah.
Totally cool. First of all, before I proceed, and where I'm going to go here is I get a lot of questions on my YouTube channel and from, folks just calling in at work on the trade desk about the indicators that I look at and what maybe they should look at, what no one tells them they should look at. I would like to divulge a couple of those indicators, but before I go there, you got anything else to come with right now?
No, go ahead, Jim. I am enjoying your analysis.
Totally cool. All right. For worldwide economic growth, all right, there's several indicators that I look at. I kind of keep them in my back pocket, but I'm sure that, a lot of you guys are very savvy. I don't hold the keys to the kingdom. I'm not the genius in the crowd, but I've been doing this a long time. Notice I didn't drop an F-bomb there. And there's a couple things I want to point out, perhaps for people that are a little bit new to the markets. Always watch Caterpillar. Okay, Caterpillar's earnings, they're a measuring stick for the mining industry and construction industry. Right, and basically, Caterpillar's their stock has been getting smoked for the last year and a half, 2 years. All right, they're basically tied to they're the biggest construction and mining concern on the planet. In fact, the situation at CAT is so bad, and that's their symbol, by the way, stock market symbol, CAP.
Sure.
They just announced they're cutting 10,000 jobs in 2016. What do you think the management of Caterpillar thinks about worldwide growth in 2016?
They're not very optimistic.
Bingo. And you think these guys know what they're talking about? Yeah. The Baltic Dry Index. Okay, now this is a measure that virtually no one knows about. The symbol, there's two symbols, really. BDI, that's Boyd David Island, or BDIY, Boyd David Island Yankee. Baltic Dry Index, it's an economic indicator, all right, that measures the demand for shipping capacity versus the supply of dry bulk carriers. Follow me here. I promise not to bore you, and I'll get a smile out of you before I'm done. But it's the supply of cargo ships that's, it's generally, to put on my economist hat, I do have one arm, I'm pretending, so I don't have on the other hand. The supply of cargo ships is tight and inelastic. It takes like 2 years to build a new ship, and the cost of laying up a ship is too high to take on a trade for short intervals. You can't just park a ship the size of O'Hare Airport in dry dock while you're waiting for demand to pick up. Now, dry bulk shipping consists primarily of like raw materials, okay, concrete, steel, little kids' toys, cars, you name it. All right, and it's comprised of, just for your edification now, and again, I won't bore you, but I want to put paid to this. All right, there's 4 ship classifications: a Capesize, which is 100,000 deadweight tons; Panamax, 60,000 to 80,000 deadweight tons; Supramax, 45,000 to 59,000 tons; and Handysize, 15,000 to 35,000 tons. Well, the Baltic Dry Index, the BDIY, was down 13 points today to 471. Those are 30-year lows. 30-year lows on goods and raw materials that are being shipped worldwide via the world's oceans.
That's depression,
Also,
Jim. That's depressionary indicators right there. And what's interesting about it is that it's something that isn't manipulated by the government's numbers. It's something that's a clear indication that the global economy is just imploding, and we're at new. Yeah, it's amazing. It's incredible. Yeah, keep going.
Absolutely. Okay. So there's the BDY. Now there's another one that I want you guys to look at going forward. Okay, the Shanghai Containerized Freight Index, SCFI. Okay, Sally, Charlie, Frank Island. Shanghai Containerized Freight Index. Now this index has only been around 17 years, but it has dropped to its lowest level since its inception. All right, this index pretty much is the third leg in the manufacturing cycle. Raw materials have been dug out of the ground, Caterpillar, shipped to the manufacturing centers, okay, Baltic Dry Index, and made into a finished product to sell on the world market. So that's the Chinese Containerized Freight Index. There you go. You got a 1, 2, 3.
Right.
Right. Okay. So start looking at the BDIY, the SCFI, and Caterpillar, first and foremost. There's a couple others you can look at. There's the Shanghai Containerized Freight Index. I won't bore you guys. Also look at Federal Express's earnings, UPS's earnings, and their warnings going forward. And also look at Burlington Northern Railroad in the States, in terms of getting the goods from port to cities. And lastly, just to take this, to its fruition, look at trucking stocks and look at like Peterbilt and Kenworth semi-trucks, because that is truly the backbone of the U.S. economy, how things get from, the ports to the rails to the ports to the actual distribution centers. They're all at like 8 to 10 year lows. Can we blame all this on Barack Hussein Obama? Yes and no. His economic policies, his overregulation, his increases in taxes, his, the Obamacare thing. He came in a really hard situation. There's no doubt about it. he's made it worse, in my humble opinion. Kenneth, I'm going to let you wrap this bad boy up, and I'm going to go get a good meal. How about you?
Sounds good, Jim. Hey, but I can't let you go without talking about how to proceed forward in how to thrive in this environment. What are your thoughts on precious metals? What are your thoughts on where to be positioned so we don't get consumed by this depression? I mean, we're damned if we do, damned if we don't with the interest rate in terms of the economy, but how does the individual person thrive in a situation where the economy is busting at the seams?
Very nice. I like that. And again, kid, I want to come on with you again. Because you're hitting the salient points. All right, personally, I'm just going to throw a dart here. And again, no guarantees. Okay, this is my humble opinion. But I'm thinking that Fed gold could potentially migrate down to 1,000. I once again, for your edification, settled at 1049.60 today. All right, so down 27. I think we could have another $50 worth of sell-off in gold. Silver, 1370, settled down 55 cents. I think silver could go down to $13. For many years since I got to the retail end of the business, Kenneth, and we talked about this yesterday. You know, I was mostly interest rates for my institutional career, dealing with these big banks, these arrogant, won't use the word, people. Basically, I've been stacking. I've been having my people stack since about 2000, now 1999, 2001 era. And our basis on buying gold was around $200. Silver, it was like $3. It was like dirt cheap. Right now, we are in a deflationary period, and it is soon to become an inflationary period. Eventually, the Fed's lack of control over the money supply is going to lead to an explosive rally in the precious metals, in my humble opinion. And it's going to lead to a big sell-off in the indexes, S&P, nasty, well, we call the NAS the nasty, for obvious reasons, and the Dow Jones, I think we're going to see a big sell-off in the indexes. There's only two true currencies, Kenneth, and there have only been two true currencies for about 8,000 years, and that would be gold and silver, because they're not backed by the full faith of the U.S. government or any sovereign. Their value is based on how much is above ground, how much is projected to be below ground, and how much we think we can find in some other area that's exploratory. So, again, great question, dude. And I'm throwing a dart, all right? So no promises, but I'm thinking I've been stacking since 2000, and I'm going to continue to stack, and I'm using these cheap prices to add to my stack. And I'm not going crazy. I'm doing like 10 to 20% of my investable net worth. Don't sell the house and sell the wife. Well, maybe the wife. But, to finance your purchase of the precious metals. But I would encourage you to stack, ladies and gentlemen. Just small, but stack. Keep it in your house. Someday I think you might want to contact me and say, hey, Comiskey, nice call. And I assume all my contact information is going to be posted here, or should I say it verbally, Ken?
Your contact information will be posted, but if you want to give everyone a couple sentences on what they will find and what they can expect when they visit your YouTube channel and your information.
Totally cool. All right, thanks for the guidance. All right, if you'd like to talk to me direct, if you're inside the States, call me at 1-800-786-4475. If you are outside the States, call me at 312-384-1181. Once again, my name is Jim Comiskey, Comiskey. Been doing this for an ungodly long period of time, but it's a new game every day. Although we get into ruts, but it's a new game every day, so it's like a fresh. I got the passion. If you'd like to email me, please do so at jim.comiskey@ifgfutures.com. Or, like Kenneth pointed out, you can hit up my YouTube rants at Jim Comiskey Metals, or just type in Jim Comiskey on YouTube and do a sort by and get my last week or so's worth of it. I try to do like three like 20-minute rants a week. But Kenneth, well, hey, everybody, before I let you go, it's been a pleasure, and I look forward to talking to you more often via Kenneth, and it was very nice of you, and it's been a pleasure being here. And once again, I'd like to bang heads again, maybe a little after the first of the year or so. Up to you.
Jim, you've shared with us an incredible amount of information, and thanks so much for coming on the show with me today and just sharing your research with us, because even the details that you've gone into talking about the Baltic Dry, what it means, and the interest rates, and the details of the interest rates with the banks. Those are things that I think most people don't have as deep of a concept as you do. So I thank you so much for taking the time to come on the show with me today, and for sure we'll do this again in the future.